So yeah, let me start. Today I'll be talking about Netflix. Is listed in NASDAQ, NFLX, one of the FAANG companies, and current price of 376.28. Yesterday Wednesday night. So for summary overview, this company is founded on 1997 and IPO in 2002. In the four, if you count FANG as the four FANG only, it's actually the second oldest. The oldest is Amazon. And yeah, what a company does, I'm pretty sure everyone knows, is a subscription streaming service and production company, and it has a 166 billion market cap right now. So for financials, after skimming through, there's a slower growth rate in the recent years. However, they have an increasing gross profit margin for the past 5 years, and also a positive operating cash flow already, mainly due to the COVID spike during the time, and it's still sort of maintaining positive operating cash flow. But I found some interesting financial stuff, which I'll share on the additional info. And yeah, key findings: there's a huge TAM to capture and it's growing. The CEO since 1998, it's 1997, sorry, it's typo, and it's founder led lah, ever since he founded it, and he's been leading till now. And Bill Ackman, one of the, I guess one of the best investors currently in the 21st century, bought the dip, and it has quite some strong moats in my opinion, but some people can argue otherwise, but later I'll share with you my argument. So a brief history. So I split this into the 5 years, 5 years, 5 years, then hopefully, yeah, maybe the next when 2023 ends, then I'll make another story for it. Or I mean when 2022 ends. Okay, so from 2002 to 2006, it's the DVD in mails era, where the company, like, how about they figured out the idea to mail DVDs and videos to subscribers, and they want to challenge the traditional brick and mortars like the blockbusters. Then suddenly 2007 to 2012, technology has improved and people are going to streaming, and Netflix saw what's happening and they just want to adapt lah, because they can see that brick and mortar will fall lah. And yeah, it really happened, and blockbusters, one of the big companies, really fell. And Netflix saw the revenue growth slower than the cost, as the movie studios start to charge higher price for their content. Yeah, that's when the movie studios start pricing their content way higher, and it's not really that cool on Netflix, so that's why they adapt into streaming as they believe that they can scale. And 2013 to 2017, Netflix started to shift toward original content. 2012 is when they first published their own first series, and after that they followed by movies. For the first time, Netflix saw the growth of content cost slower than the growth of revenue and operating margins. Means that your gross profit margin is slowly increasing as because your own original content and you have more vertical integration. That's why your gross profit margin is actually fattening. So you can see the history, Netflix versus Blockbuster, and this is why you can see how innovation and a company that can adapt would yeah would prosper lah. While the traditional brick and mortar, they probably peak around 6 billion revenue in 2004, and that's quite huge, and they just fell bankrupt after that. While Netflix just kept rising. So for the key management, since 1997 until now, this is the founder and right now it's a co-CEO, because the CEO has actually split into two people already. So currently, Reed Hastings is still the CEO. He co-founded Netflix in 1997, and before that, he was actually a teacher, and he served as a high school math teacher, and after that, he transitioned into technical and software engineering. After that, he founded his own software company, and he sold it off. And yeah, after he sold it off, he started off this company on Netflix. So it's quite interesting. He went from a teacher to a tech guy, and right now a founder, and yeah, quite interesting. So this is the other co-CEO that he picked up, and this guy basically he's the reason why you can see original content like Stranger Things, La Casa de Papel, and Sacred Games and The Witcher and stuff. So without him, you won't have all these top-notch movies and he got promoted as co-CEO because of his vision that he can see the original content is needed and is building a moat in a sense. And House of Cards when 2013 launch is a banger hit also. So far everything that he produced is so far been very solid. And other than that, this is a global heads of partnership. So she basically oversees all the partnerships for Netflix. Let's say like you partner with Google or other streaming companies. So basically, she will be handling that. It's quite important because partnership help growth quite importantly in the when they got their own original content. It really helps for your growth And before that, she worked for I think partnerships for YouTube and stuff also and emerging markets. So basically, she has the background for it also. And this guy's a CEO and a chief product officer. So basically, how your Netflix works, basically all him. He designed, built, and optimized the Netflix experience. And before that, he was in other other tech companies and software providers like especially specializing in entertainment software provider like Mediabolic, Red Hat Network, and he also does some open source work also. So those are the key leaders. I'll go into business models now. So we can see mainly I want to focus on the value proposition. They've been adding more and more value, and uh, right now there's no ads and high stream definition. I don't know whether they change the ad and follow the other business model like Roku, but I don't think they will. And basically you get also algorithmic recommendation, and you get a freemium model. You get 30 day free trial. After that, you see whether you want or not. And the revenue stream are very basic, just basic, standard, and premium. Basically, just all subscription plans. And the cost structure, cause last time they didn't produce their own movies, so now they produce their own stuff. So other than just purchasing the rights and stuff, they have to include the cost of producing movies and cost of R&D and artificial intelligence and maintenance costs. Oh yeah, fun fact is that I realized that they still have their DVD mailing services, but uh, of course declining lah. And I think you just keep it there for fun only. So right now their product. So this was what their product are. You can watch anywhere you want, like PlayStation, Xbox, or Chromecast, or Apple TV. You can watch it anywhere, and you can download your shows offline. They have a plethora amount of shows that you can watch wherever you want. You can watch everywhere, stream unlimited, and your phone, tablet, laptop, or TV. However, 70% of their customers are watching on TV, but I think 30% they sign up a phone first, and then they slowly go to laptop and TV watching already. And right now you have kids and parental control. So they have their own content available in Netflix and serve a lot of plethora of genre. Netflix originals, that means only they have it. And of course all the action, anime. Yeah, they recently actually added anime in the recent years because they saw a rise of it, and it's a strong move by them and it's quite good. And of course like all those romance and sci-fi and stuff. Oh yeah, K-pop also. And product wise, strong names produced by Netflix like Squid Game, of course everyone know, and Arcane. If you play League of Legends, it's a game by Tencent. This is by Riot Games and bought by Tencent, but one of the best hitting show, and I think it's rated number one for game content related movies or TV series. And these are the other household name like Moneywise and Stranger Things. This later I explain more about the Daredevil and Marvel. Black Mirror and House of Cards also. So we can see that 6 out of 10 of the most searched shows or TV series are owned by Netflix originals, and two of the movies are. So the series wise, we can see Squid Game, Cobra Kai. These are the two that I watch. I have no idea what the others are, and they are ranked pretty high up lah. for 2021 the top 10. And for movies wise, they are slowly penetrating in and beating up like the old box movies. However, Marvel is still taking the number 1 and 2 spot, number 3 or so. But however, we can see Netflix originals slowly creeping in. So for another product wise, the algorithm. So if you watch a movie or a show or a series, just suggest to you more shows and series that they think that you might like, and yeah, so that you can keep watching it. Another thing that I read recently is Tudum. It's basically like the BuzzFeed of Netflix. They give you more insights and articles about the shows, movies, and if you want to find out things about the actor and stuff also, then they'll show you. And this helps to keep the community engaged and know more about the movie culture. You also find info that may encourage them to watch shows that their favorite or actor and actresses are in. So let's say like after you watch finish a Leonardo DiCaprio movie, then you click on the article and maybe you found out that he's in another movie, and yeah, then after that the fans will watch it lor. So for more product overview, they actually have other things like Fast Laugh. Fast Laugh is basically like a, you could say it's a, as the name Fast Laugh is basically a TikTok like that lah. Then yeah, for Netflix, but it's for the they take moments from the Netflix content lah, and then content for kids and gaming experience they recently got into, and they acquired another company later I'll talk about, but previously they acquired this company, and they're just testing waters and e-commerce site also for merchandise. Let's say The Witcher, you have some fantasy necklace and some cool, I don't know, wolf tooth or something like that, and yeah, and Tudum. These are basically all the products so far. So for product pricing, standard is the most common for after surveying the price points, and after that we can see that of course our standard is the gap from basic to standard is is quite worth lah. However, from standard to premium, do you really need like 4K HDR? Maybe the 4 screens but yeah, you can see why people choose standard, and maybe it's a marketing trap where yeah, they can see usually I forgot the term already. There's a study where like the middle one is the one that people buy the most There's a even McDonald's
Yeah,
uses this also.
yeah, they always use that to trap you in between that
Yeah,
you think is the best. Yeah, and enough. Mm.
that's the product pricing, and that's how they capture you. So for revenue growth, we can see, well, imagine if I said 2002 when I was born, yeah, right now it grew until like 24 billion, 25 billion but this is 2020. The recent one is 29 billion actually. So it's quite a huge explosive growth, and 2020 is actually fueled by COVID. Really helped a lot lah, cause everyone stay at home and you basically just Netflix. So for subscriber count, and yeah, this is a recent quarter. I think it hit 221 million. We can see over the years it has quite a huge explosive growth, and especially starting 2020, you see like huge blocks, especially quarter one, and that's why Corona, and after that it's normalizing, going back on the normal growth speed. Then another thing interesting is that the pricing increase, they have the power to increase price as they grow, and yeah, this shows the pricing power lor. We can see that way back before in 2000, let's say 2013 and it was just $12, and right now it's around $20 for the premium one for the US, and let's say the standard, the one that most people subscribe to, $8 to bloody almost 16, doubling in just almost in 10 years time. So they have the growth in pricing and the growth in subscribers. However, they have a guidance forecast, and that's why it really tanked a lot when this came out. Their guidance, they only gave it around 2.5 million new subscribers for the next quarter. So a lot of investors probably got scared, and yeah, not really that cool they think. And of course, we can see 2020 is a huge growth, mixed in COVID. However, now it's slowing down. So for geographic breakdown, we can see that from 2020 to 2021, we can see the growth of international regions actually faster than uh, United States and America, which makes sense because United States and America is where they start off with, and it's getting more and more saturated with like other competitors coming out. And yeah, but overseas opportunities are way much larger, and especially APAC and uh, what is that, Latin America and European region. So we can see the average revenue per membership in 1 year ago it was just $13.51. However, now for United States of America, it basically adds another dollar plus. So it's like a what 10 to 11% increase by just in just 1 year. For the European side, it's $11 back then, and right now it's $11.65 ish. So that's another what 7 or yeah 5 to 7%. Then for Latin America, it's quite a huge growth in the price, and also a huge growth in subscriber count. So 14% year on year. And you can see $7, you suddenly can price it at $8 now, and your subscriber count from 37 million to 40 million. So there's a huge growth opportunity. And however, APAC region is the only one that they don't dare to increase the average revenue per membership because they say that the competition in APAC region is way tougher. And also we're more Asians APAC region tend to be more traditional because I'm pretty sure you can tell from like the later I'll show you the age demographic and understand why I'm pretty sure that most of our parents won't use Netflix and that's where most of the disposable incomes are at, where you hit a certain age So for income demographic, you can see low to middle income. So most of it is, I'm quite surprised that it's actually mostly here. I thought that it would be 50 to 70k, but apparently when you have more than 25k, you have disposable income for Netflix already. This is in the US and you're considered quite a low income in US also. So that's pretty interesting. And you would think that more disposable income means that more people will subscribe, right? But um, yeah, however, we can also argue that there are lesser people with more than 150k per year. So maybe that's also an argument.
Because while they're watching Netflix, others are working.
Yeah, oh, that one also. I think other people are probably working from home or something, right? So for age demographic, maybe it correlates with income. Young people have no money or they prefer to play games instead. Later I'll show you the when the competitors are later positioning also of why the trend of young people. And right now we can see that most of the people are from 25 to 54. So the millennials onwards those are the huge demographic there. So sharing account problem, yeah, 2019 they said they want to address this issue, but it's also very hard to address this issue. I don't know how they're gonna stop sharing account. It's really the same password, and they can't IP ban. If they IP ban, they will be going against their motto where you can watch anywhere you want. So yeah, so around, however, there's around 50% don't share their account password And viewership, not subscriber wise, we can see that the viewership it's around what 670 worldwide. However, they have like 200 something people subscribe only. So that means people are sharing and watching together in some way. However, it's only like around 8% of the world population, so that's still quite a huge TAM in a sense. Industry and positioning. So right now, total the cable still makes up majority of the TV viewership. We see cable and satellite, even though online subscription has grown. Let's say online subscription right now, 2021 we give it around uh 60, 60 or 80 billion but cable and satellite is still a huge market share to take over. And I believe that as you grow older, they will slowly shift because older people die or they adapt into streaming online subscription And we can see that streaming is growing fast, and although they generate lesser revenue than cable as I shown just now, the previous chart is revenue, is because the amount that traditional cable charge is way higher than what Netflix charges per month. So that's why. But however, we can see online subscription. That's why the price is increasing, and because their value proposition is increasing also. And their online subscription, yeah, you can see 2014 is just this amount. Then right now it's around 600. This is 2018, and it's probably more now. The trend lah. The trend is going to streaming instead of linear. We can see that over the years, people are cancelling their cable and they're going to this is the cable lah, and apparently 65-year-old and people above are still they're increasing in cable, but generally speaking, more and more people don't use cable anymore. And other than that, they still have a huge growth potential, and of course, grow by high income country first, more money, and in a sense you have more disposable income for subscription. So uh I would say UK and Western European side first would be the next saturated part. First it will be North America that's saturated, then followed by EU, then after that maybe other regions like Latin America or Asia will be saturated next. So other than that, we can see variety of people are still watching shows and movies, and of course in the next 5 to 10 years, they will still be relevant as it's still a big portion of people's time. So Netflix focus more on the Gen X, and yeah, as I show you, it makes sense with the ages now. Gen X, millennials, and maybe Gen Z. We can see that there's a trend of decreasing watch TVs, movies or shows. However, it's still a big portion. I believe that next 5 to 10 years, they'll still be relevant. So for total, by KGA wise, this is by several statistics. I'll use the most conservative. I'll give it 10% lah, 10%. Of course, they'll say for other you have like 14%, 30%, and 14%. But I'll give it the most conservative 10%. So at the bare minimum, bare minimum, they have a 10% growth for the next 5 years. However, competitor-wise, you can see in such a huge market like just now, what 251 billion in such a huge market. Right? 2007, there's only like this 3 players only, but now there's more than don't know how many players, and I didn't fit in like the region-specific players like VO for our ASEAN Southeast Asia side. I didn't even fit in there yet, you know. So there's a lot of players So for competitor products, in depth I'll go into like this main competitors Disney is the most dominant one so far because of their intellectual property like they literally have so many things to use, and the key thing about Disney is that they have the power to monetize their intellectual properties in many ways, like theme park merchandising, and right now they're going to streaming. Then for Hulu, they launched around the same time as Netflix, but they didn't have like they struggle so they got bought over by what is that, Disney. So yeah, Disney acquired them, and they bundle with Disney Plus, so they have more value in a sense. Prime isn't really the same league because it's more like an add-on for their e-commerce, like their Amazon Prime membership already, and the content there is not as much so yeah. However, they have some recent nice content which I would consider, like especially the animation. One of the animation that I recently watched is Invincible, and I think Amazon surprisingly did a very good job somehow. Then for HBO Max, it's one of the older legacy players. However, they have a lot of good quality shows and might be some competitors. Apple TV, I don't know what they do. I genuinely have no idea because this is the first time I've seen people have Apple TV, but yeah, apparently they have. However, apparently they say they are struggling because they have no original content. So it makes sense the game of like this streaming industry is usually what is that, original content, because you need to go there to watch the content. So it is the power of Mickey Mouse and Thanos. In 2 to 3 years time, Disney only released Disney Plus in 2020, 2020 or 2019 last quarter, and they basically caught up like half of Netflix subscriber base already. Quite crazy to be honest. And yeah, we can see their intellectual property. They have like from Marvel, Star Wars, then to their classic cartoons. That's why they're so strong lah. Which makes sense also. And they bundle with Hulu and ESPN. ESPN, if you're a sports person, is basically all those sports channel lah, and ESPN basically dominated the sports market.
Because Disney has the content,
Yeah,
especially for the kids. So when parents they have kids, parents can do everything for the kids, right?
yeah.
They are more than willing to spend that kind of money. So yeah, it's quite impressive.
No,
Almost.
funny dude. Like, it took Netflix 10 plus years to get to here. They just launch it in like 2 years. They already half of Netflix already.
Yeah, but you have to bear in mind the Disney, they have the contents for also 10 years plus already.
Yeah,
Yeah. So this is IPO.
it's a strong mode lah. Maybe next time I'll cover. Okay, I never knew that they actually grew that fast, but maybe I'll cover next week for Disney. And yeah, maybe for recovery play also. But right now, go back to Netflix. Disney Plus seems like a formidable competitor. They just started in 2020 and they're eating up quite some market share already. And right now, Peacock also quite interesting. Peacock they give for free, so I don't know how they're gonna. But it's not. It's a private company and they really take up quite some market share. So Peacock might be another thing to watch out for. So we can see a declining market share from Q2 2021. Netflix is around 48%. Q4 2021 they are 45%. And yeah, we can see especially Disney grew by 1%. Well, not yeah, not by 1%, but in market share terms it's 1%. And yeah, Hulu also grew. So Hulu and Disney are together, so because they're bundled, and yeah, they grew together. However, let's look at the churn rate. Actually, if you look at the market share, of course, yeah, Disney is stuff all doom and gloom. But churn rate wise, actually, we can see that less people are unsubscribing from Netflix compared to others, and we can see that's a sort of a mode lah. Even though with so many disruption happening, but Apple TV is the one that's really sad. They have a 10% churn rate. That means every month, like 1/10 of your customer are exiting already. So that's very sad lah. And yeah, Netflix is only 2.4 churn rate, and it's quite consistent over the years. And Disney is actually also very consistent because of the IP and yeah. So Disney is the second one and over the average is around 5 to 6% ish. So as long as you're below that, you're pretty good lah. So for competitor wise, these are what people estimate, and I would also say it's not a bad argument lah. And with the speed of Disney Plus and stuff, we can see that we expected Disney Plus to exceed Netflix by 2026. And Western European side, the next growing market that may be saturated, we can see that it's gonna grow lah, and Disney is gonna catch up quite fast also. Netflix will of course grow, but Disney will be catching up very fast, and Amazon also. So, but Amazon one is just a value added lah, as I said. So for time spent, we can see how many people spend their time on Netflix and stuff. So these are by time, total time spent daily. Usually, last time a lot of people Netflix, and right now slowly declining as Hulu and Hulu and Disney are coming in. However, we can see content quality wise, Netflix has a power to make original hit shows and compared to others, even Disney with strong IP can't beat Netflix original content for series. For movies, Disney hands down. But for series wise, we can see that all this Ozark, Tiger King, Umbrella Academy, Cobra Kai, they still stand strong. However, Mandalorian and WandaVision slowly creeping in and this is by 2020. I don't have the data for 2021 yet, so it might be quite lagging. And a quiet series, if you want to count it, you can, but a quiet series, uh, most of the movie, most of the shows here are available on Netflix. However, like Criminal Minds, the top three is on Netflix and Disney Plus and stuff also. So I didn't count a quiet series but you can count that if you want. But that's like a shared one. All the old movies like Supernatural, and NCIS, Vampire Diaries, they you can watch on Netflix and you can watch on Disney Plus and Hulu and stuff. So for valuation wise, Netflix may be overvalued compared to some peers. When you see a Netflix on the borderline of the median for PE wise, you may think that they are undervalued, but I would say overall, especially with EV EBITDA and price to sales, they are overvalued. And yeah. And let's go to pricing. I got this Singapore pricing, and usually they price by countries and countries, as long as your first world country and stuff like that, usually is around the same one. And I checked the US pricing is basically the same for Disney and Netflix. I didn't check a lot of the others but yeah, when I see Netflix is price premium compared to others. HBO can price this much because of the amount of quality content they have. And yeah, so basically Netflix and Disney are quite close competitors. I'm surprised that Disney doesn't have free trial, but Netflix have a free trial, which may be why they can still grow in a sense. So for moats, I would say that there are three strong, I would say decent moats. Pricing power, they can increase the price as they're growing at a fast rate. Brand powers, even when Disney and other competitors come in, they still have a more than 16% growth although it's diminishing, but the growth is still there. And they have economies of scale because the content is fixed cost, and as you acquire more customers after that, your cost doesn't need to scale up because you already filmed there already, so you just need to put there and use more value added So as you go, you can scale more. And you can see like the average ARPU average revenue per user in US and Canada, how they increase over time. So for financial wise, total revenue, 2016 they have around 8 billion or 9 billion ish, and right now they have 30 billion, very impressive. However, you can see recent years, the growth has recently hit below 20%, so that's very sad. However, their margin wise, gross margin, because they produce their own content, their gross margin wise has increased, and their EBIT operating margin is around been 20%. And they also forecast that for 2022 and beyond, they'll keep it around 20% level. And the profit wise, they've been growing consistently also. So for quarterly, let's break it down more. We can see COGS, cost of goods sold, is basically a cost of revenue, how much is spent on content. We can see that recent quarter, they suddenly have an additional 1 billion spent. So many people may think that's concerning, but later I'll explain why that may be a good thing. Additional info, it's quite interesting. And we can see some seasonality involved. As the last quarter every time is usually positive. We can see seasonality because they say that during the Netflix subscription correlates with the amount of screen people buy, and people will buy more like iPhone or laptop, or like because Black Friday sales and Christmas, and you buy more of those screen now, and when you got more screens then you buy more Netflix, and that's why they say they got more sales during that time. Let's go to the next slide. So for income statement, the quarterly, so what they spend so much so in one quarter you have a revenue of 7 billion but you spend 5 billion. So most of the cost of revenue components are amortization of streaming content, and basically licensing, acquisition, production, delivery, and stuff up. So it's all the things that produce content. And you can see that the cash balance suddenly decreased, and people are scared lah. Your cash suddenly decreased year on year. However, your total assets has increased by 5 billion, and your total liabilities only increased by 500 million, and your total debt has decreased by around 1 billion. So that's a good thing. But however, people are saying that you still have around, let's say, 15 billion of debt worth, and that's very scary. So I'll go through the cash flow statement. So majority of the expense are actually from this amortization, and basically how much they can they say it's depreciating later. It's very funny how they can make until 12 billion and then yeah, other operating asset, this is the cost of revenue, and yeah, it's the interesting, the good thing is that they are still positive after the, even after the COVID boost, they can still remain positive. And they actually, I think for this recent year, especially the last quarter, they especially invested more heavily into the content and they have some acquisition and capex, and quite some capex also. And acquisitions because yeah, they branch out to gaming as I explained just now. However, we can see the no longer new debt issued. That's a good thing, and they have repaid around 500 million and repurchased around 800 million of common stock. So they're starting to repurchase common stock already. So for valuation wise, Finbox, I checked all their models is all around 500-ish level at least. And yeah, they say that it's undervalued. We can see they compare FAANG and Fox. They didn't really put in Disney there, so I'm quite surprised. Yeah, around 480, 500-ish level. So for valuation for myself, I'll give some simple assumptions. We can see that the growth is slowing down from 30 to 16%. Let's say I assume that it will grow 10%. I'll give it like a quite some conservative for the next 5 years, considering that their customer is growing and their price increases 5 to 10% depending on regions year on year. The GPM also seems to be increasing also, but I'll make it constant and I'll give it. They also say that they'll maintain an EBIT of 20% ish. And for free cash flow wise, they say they'll be positive from 2022 onwards. But I'm lazy to do the DCF valuation, so I'll go with like the basic price to sales model. And based on FAANG stocks and other tech stocks, actually you can give it 25 PE also, but I'll use price to sales because I'm not very sure. And price to sale of 5 to 6 with all the FAANG stock is quite reasonable, especially on a pre-COVID level, so you can check for a more mature phase of Netflix. This without the fact that there will be free cash flow positive and buyback shares, and I believe that my assumptions are quite conservative. I'll give a 13% discount rate for better returns and 10%. And last time remember I used like 20% and stuff because those are the losing making company, and Netflix has proven its business model, and that's why I give it 13% but of course must still be higher than 10% So I'll split out the 5 and 6, and in case 10% chance it will reach 7 price of sales So after discounting, I feel like the fair price now is $420. So for technical wise, you can see a huge sell off, suddenly a huge dip, and it broke through the support structure of 475. So yeah, we can see if it really breaks through this level, perhaps there'll be more value. However, we can see a strong momentum going downwards. That might be scary, but I believe that it's going to consolidate here for like at least 1 or 2 more months. And yeah, the Fed interest rate is gonna decide quite some stuff and weekly wise you can see momentum is slowing down, especially RSI went to oversold, and MACD also slowing down momentum. And we can see that maybe there's a continuation downturn for daily, perhaps gonna break through this level. And yeah, so that's for the technical side. Right now it's a bear market for Netflix, definitely a bear market. For competitors, I added in Disney, Amazon, Comcast, Fox, Apple, and Roku. So yeah, we can see Roku really. I don't know, man. I thought Katie Wood really invested in Roku, so I thought they would be doing better, but I guess not. And I'd say Apple is the one that even during the fat economic downturn and stuff, Apple is still doing strong. And we can see Amazon is also doing decent, followed by Disney is really Disney is also going down together with Netflix and Comcast also. Fox News is apparently doing okay. It's value stock as a traditional media and just sidewaying it. So yeah. However, Apple you can see out of all the FAANG, Apple is quite strong. Shareholder Info. We can see out of these top 25 investors, we can see Hastings is one of the top investors and is around 2 billion in it almost. This is without the recent Bill Ackman. This is because this is the data from 12th of December 20th or 30th. And Norway Bank, it's quite a prominent sovereign wealth fund bank. So yeah. So Hastings and Hoek, sorry, my butcher's name. This guy is actually a successful tech investor and one of the earliest investors in many tech companies. I think he invested in Netflix and what is that? Facebook and stuff also at the very early stage, early 2010s or stuff. So he's doing very well. So for additional info, macro factors, of course, the rate hikes, Wall Street targets, of course they will target quite high still, although it decreases over time, but it's still quite relatively high. Glass Law, legendary CEO in my opinion, with great history, and how I remember the story of them wanting to sell to Blockbuster, but Blockbuster declined them, which is very funny, and Blockbuster went to bankruptcy and Netflix still standing tall. And good working culture lah. Over the years, they say that it's very competitive there and long hours, but you have a lot of freedom, responsibility, and very good pay and good mentors. And it's founder led all the way since IPO of since it's founded. And this guy Bill Ackman, recently last 3 weeks ago, he just spent $1 billion in Netflix. He's quite an investor. You can see his track history. Over the years, he has a CAGR of 18.2%, and S&P is only 8.7%. For you didn't even count the 2019 and 2020 and 2021 yet. He even have a massive growth. So this is before the bull run. So it's quite not bad lah. So for risks and headwinds, competition like Disney is growing and taking shows away from Netflix. Like yesterday or 2 days ago, they even announced that they will remove all the Daredevil, Jessica Jones, Luke Cage, and Iron Fist from Netflix, and also Agent of Shield also will be removed from Netflix and only exclusive in Disney Plus. However, the future growth plan, many people think that it's quite bleak and no more COVID boost, and work from home will be a trend, but people are going back office now. That's why I give it a 10% CAGR just now, and not what people will give a 15. I'll give it 10% now. And this is the power of Mickey Mouse, and yeah, you can see 2020 to 2022. Wow, 100 million. So yeah, 100 million add in new users are crazy. You can see some recent acquisition. March 2 days ago, they bought another gaming company and they want to give more value lah, and specifically add games that are related to their shows, like for fans. And this is a gaming studio created by fans for fans, and it's like Stranger Things and Walking Dead and stuff lah. It's to sort of keep them in the app and yeah, keep them more engaged, fans engaged and more hyped up for the upcoming shows. Okay, this is where I break down the financials more seriously in a sense. So you can see 17.7 billion is spent for the recent other operating activities, and we can see that it's quite crazy lah. And however, we can go back previous years and see that last time they only spent 800 million or around 2 or 3 or 4 billion lah, and they still can have some growth. So I believe that you can argue that this new 17.7 billion is for maintaining and also for growing or customer acquisition growth. However, they you spend so much, okay, but then you amortize as 12 billion and they wrote off as expense so that you can lower down tax out of the 17.7 billion, and they put an argument, okay, in their annual report. On average, they say that over 90% of the value would be gone after 4 years, which I don't think makes sense. I believe that your content is still there after 4 years, and let's say like a new person that subscribe, of course you want to watch like Stranger Things and stuff. I believe that this will reduce their taxable income and also to give them a more conservative they give out a more conservative free to cash flow also, and also they give out more conservative for the income statement now. And yeah, this means that your expenses are overstated with this sort of loophole, and your free cash flow or profit or OCF which should be way higher because amortization and depreciation are expense. Then so how the debt? You have like 15 billion in debt still. So since your content is so heavy, let's say yeah, out of 17 billion, 5 billion of them, let's say I'll give them a 4 to 5 billion it's just them reinvesting for more growth, and they actually don't need to do this, and that means they actually have 4 to 5 billion of free cash flow actually extra. So break down the debt wise, we can see that in less than a year they have the content obligation, and this is for the this really signed contract already, and they have to pay for the actors and all the producers and stuff lah. So I guess this is a debt that locked in, and the other debt, let's say out of the 15 billion, you take out this 9 billion, you still have 6 billion, and you can pay away those 6 billion easily with your 4 to 5 billion if you didn't reinvest for growth, and that's why they didn't repay them that fast because they know that they actually can pay them anytime they want to. So and the more important thing then for now is the growth, and that's why they're investing more back for more growth. And then yeah, this is just me sharing that the free cash flow or profit or OCF should be way higher because as I said, they say 90% will be gone in 4 years, which I don't think makes sense. So for conclusion, honestly personally I would buy this. It's a great business and a leader, strong free cash flow, and if they didn't understate Bill Ackman, I want to see how because he's known for activist investing, which means he is gonna talk to management and probably change some stuff, and strong moat and some scuttlebutt theory, some stuff. A lot of my friends use it and has been using it ever since 2017, at least as long as I know, probably even earlier. And I live in a developing nation, and if my friends can fork out every month like around 40 bucks ish or 50 bucks for Netflix, I believe that it's quite a strong. There's quite some. I believe that other people will be willing to also lah. And yeah, that's it from me.
Yep, thank you, Jason. So I think the key is they can continue to develop their content.
Yeah.
And I'm just wondering, for you all, do you think Netflix is very much up to date? Like,